everyone for joining. My name is Will Osborne.
My name is Ryan Connolly.
And yeah, we're discussing self-directed IRAs and real estate today. We'll go in depth and cover various topics on real estate. So let's just get right into it.
Let's do it.
All righty. So let's start with the basics. So what is a self-directed IRA? So at the end of the day, this is an IRA like you'd find anywhere else from a tax perspective. The difference is we have the ability to hold alternative assets. So a self-directed IRA is an IRA that lets you invest into alternatives, which includes real estate. Other than real estate, you can invest in private companies or maybe private real estate syndication deals or REITs, promissory notes, precious metals, etc. So we have various webinars on other asset types which you may be interested in, but today obviously we're just going to dive into real estate specifically. And in my experience, and I'm sure you'll find the same,
Exactly.
most of our clients come to us to invest in real estate in some form or fashion.
Right. I'd say for the most part, probably, if I have a good estimate, 70%.
That's fair.
Just about.
Yeah, exactly. I'm talking about it every day. So yeah, let's just keep going.
All right. So now I'll jump into the difference between a self-directed traditional IRA versus a self-directed Roth IRA. So I'll just jump into the traditional first. It's a tax-deferred retirement investment account that is funded with pre-tax dollars. So in essence, upfront, you're getting a tax break on your contributions. And then upon retirement age after 59 and a half, when you start taking withdrawals, it's generally taxed as ordinary income. And then Roth, think of it as just the opposite. So you're funding the IRA with dollars that have already been taxed. And then when you take it out after retirement age, and assuming it's been open for 5 years, it's all going to be tax-free and your money at that point.
Exactly. Exactly. And the amazing thing is this applies to all asset types in the IRA. There's some exceptions, but even in real estate, even if the IRA is invested in real estate, whether it's Roth or traditional, these tax implications still apply. Either the deferral of taxes with the traditional IRA or tax-free distributions if you meet those two criteria.
Yeah.
All right, so we dove into this a little bit. So it's much easier to list what you can't invest in an IRA than what you can. We'll be here all day talking about what you can.
Yeah.
So as you can see on the right-hand side of the slide, life insurance, any investment involving life insurance is going to be prohibited, definitely with Madison Trust as well. Anything involving life insurance. Collectibles are off limits as well in IRAs, and S corporation stock. S corporation stock, that's a weird one. It's really because S corps can't have trusts as members or shareholders. That's my understanding, at least. Yeah. So, and IRAs are technically trusts. So that's the logic there. Beyond that, this is just a Madison Trust specific policy. We don't hold foreign investments directly. Through a checkbook IRA with an LLC or trust, you can invest in foreign assets. I'm sure I'm going to cover that.
That we'll look at that later as well.
And anything federally illegal, we won't hold either. Or any investment involving anything federally illegal. Other custodians might accommodate that. We don't. So when it comes to what you can invest in, real estate, again, by far the most popular. You'll see the gold bars there. Precious metals is also popular, and investments in private companies, partnerships, lending funds from your IRA to certain individuals or certain businesses is also allowed. So tons of possibilities through this type of account.
So now I'll dive into what types of real estate can you invest in. And the list is long. It's pretty open in regard to what you can invest in. So just to name a few: rental properties, condos, single family, mobile homes, commercial real estate, raw land, private REITs. I've seen timberland, I've seen different types of, land, mineral rights, things like that. Usually in the checkbook IRA, of course, but it's pretty open.
It's open.
In most cases, you can get pretty creative with what you invest in.
Exactly. There's no limit to the type of real estate. There's other limitations that we'll get into, but there really is no limit in terms of the type of real estate.
Exactly.
In an IRA. So the benefits. So some of this is fairly obvious to some of you, since I'm sure some of you might have expertise in real estate or have experience investing in real estate. So you think, why don't I sort of take advantage of my knowledge base and do the same thing in my IRA, which is what I find a lot of the time with our clients. So the high growth potential, at the end of the day, this all goes back to diversification, taking your IRA, which for most people is typically in the stock market and equities, and diversifying into real assets, real estate in particular, high growth potential, Generally speaking, it's a real tangible asset. And you still, as I mentioned before, you still get all the same IRA tax advantages in an IRA that holds real estate. So you're deferring capital gains, or not even deferring capital gains. There are no capital gains
exactly.
taxes.
Yep.
When you take the cash out or even the equity of a property out of the IRA, the value is taxed as ordinary income. So at the end of the day, the main benefit or the reason why you'd get into real estate is diversification. But if you already have that knowledge base, this is something you do in your normal day-to-day life, then why not take advantage of your experience and expertise?
Exactly.
And
At a tax advantage.
and a tax advantage account. Exactly.
And then I'll jump into what is a self-directed IRA custodian. So the Internal Revenue Code IRC section 408 details that all IRAs must be held by a custodian. So that's us. On the other side of the coin, like Charles Schwab or Fidelity are considered custodians for IRAs as well, just for an example. But basically, you just act as an IRA custodian. So basically what that does, we hold the account's investment in custody, place the transactions upon the direction of the IRA account holder. So truly self-directed. We can't move money without your permission. And then complying with all the IRS rules and regulations, which we'll get into later, surrounding prohibited transactions, disqualified individuals, kind of all that good stuff. And then obviously maintaining the tax advantage status of the IRA.
Exactly. And there's just one thing I want to mention that comes up sometimes. There's a list out there of IRS approved custodians or something to that effect. You're not going to find Madison Trust on that list. You won't find any of our competitors on that list. And that's because we are structured as a trust company and we're regulated by a banking authority. So from the IRS's perspective, we're a bank and we're qualified by default, for lack of a better term, to custody IRAs.
Right.
On that list, you're going to find brokerage firms or companies that needed to apply to become IRA custodians. So for those of you doing your research, you may come across that list. You're not going to find Madison or other self-directed custodians on that list for that reason, because we didn't have to apply to become an IRA custodian. We already qualify. Right. Our banking regulator or authority is the South Dakota Division of Banking. So for that reason, again, we're considered a bank for purposes of holding and maintaining IRAs, and in our case, self-directed IRAs.
Absolutely.
All right. When it comes to titling, the IRA is quite literally purchasing the property. So your name's not going to show up on there directly. You're going to show up as the beneficial owner, I suppose is the correct term. So as you can see there, Madison Trust Company, custodian FBO, so for benefit of, and then your name and your Madison Trust account number. That's going to show up on title. That's going to show up on the deed. And on a purchase contract, that definitely needs to be listed as the purchaser. Ideally, the account is opened and funded with at least enough money for an earnest money deposit before you start making offers.
Yeah.
It's not the end of the world if you're coming to us after the fact, but it may be, I guess, irritating or not feasible,
not ideal
for the agent or for the seller. So have everything ready to go. If you're serious, you know you're going to get into real estate, you might as well open up the account really as soon as possible. So you have the titling ready to go and bring some funds in. Maybe even a contribution will cover it.
Yeah.
You won't necessarily have to start a transfer if you don't want to or don't need to. But keep that in mind. The IRA is literally purchasing the property.
Right. And then a couple important considerations to note: income and expenses. So basically any income generated from the property would be deposited back into the Madison Trust IRA. So that includes checks, wires from tenants, paying rent. If you wanted to sell the property, anything along those lines. Same thing goes for any other investment. If it's like private equity or promissory notes, that interest or dividend income is going to have to flow back to the self-directed IRA. And then basically also completing the deposit information form, just to let us know to classify those funds, whether it's wire, check, or ACH, doesn't really matter. But,
exactly.
Then I'll say, kind of on the other side of the coin, all expenses related to the property will be paid directly from the self-directed IRA. So that's basically by submitting an expense payment request form to Madison Trust, a copy of the invoice, and then letting us know, where to send the funds. Same thing, check, wire, ACH. And we could send it off for maintenance costs, property taxes, HOA fees, anything that could come up. And that's, could happen within a property. Also important to note that all invoices and tax statements should be invoiced to Madison Trust Company custodian, FBO, your first and last name, and then your Madison Trust account number, including the property address, and then the property identification number on it as well. And then lastly, tenants, like I alluded to this a little before, but they basically make checks payable to Madison Trust Company custodian, FBO, your first and last name, and then your account number. And then we receive the check and then deposit that into the IRA on your behalf.
Right, exactly. All right. So for real estate, the checkbook IRA is by far the most popular way of purchasing and maintaining real estate. So everything that
Absolutely.
Ryan and I have said so far assumes that the property has been purchased directly through the IRA. So when purchasing property directly through the IRA, we require clients to send us all the documents related to the purchase. So the purchase contract, closing statement, draft of the deed, title policy, that's
Yeah.
all coming to us. As the custodian, we're reviewing all of that, signing off on it as well. The client would just sign the purchase contract in the capacity that they've read and approved it.
Yep.
And same idea for the expenses. He already went through it. Madison is taking care of those expenses. Fill out that expense form, send us an invoice. We send it on your behalf. And that does come with transaction fees and processing times as well,
yeah.
which are pretty minimal. But for some investors, some real estate investors, those processing times and transaction fees are just not going to cut it. So that's where the checkbook IRA comes in. So really that's referring to a self-directed IRA with Madison Trust that holds a specialized LLC most commonly.
Yep.
And that LLC would give you real-time access to your IRA funds. So the sole member of that LLC is the IRA. So that titling that I mentioned, Madison Trust Company, FBO, client name, etc., that's going to show up in the operating agreement of the LLC as the member. And the purchaser of the property is now the LLC. So it's a little bit different than what we mentioned before. But again, the purpose of setting up the LLC is really the convenience. You have a checking account for the LLC. We move your IRA funds from the Madison account to that LLC checking account, and then you'll take care of the purchase from there, making sure that everything's titled in the name of the LLC. And since you have that checking account available, you don't have to get Madison Trust involved when it comes to paying expenses. You're just paying it right out of that checking account, wire, ACH, debit card, whatever, check. It's completely up to you at that point. So any transaction heavy investment like rental properties or fix and flips, you're going to want the LLC. Or if you have to go to an auction to purchase the property, our processing times just aren't going to cut it.
Right.
So the LLC is a must. So keep this in mind. Again, this is by far the most popular way of going about purchasing and maintaining real estate after the fact.
Yeah, I'll say, and to add to you, I'll say the short-term flips, fix and flips, things like that, and tax deeds or tax liens pretty much require it.
Yeah, exactly.
I guess
it's just the way
it has to be. Yeah,
exactly. From an admin point of view.
In other cases, long-term rentals, things like that, it's helpful to have it, but it's not as I guess strenuous in regard to processing times and things like that. But it's still very helpful.
Exactly, not required as we've already mentioned, but it's very helpful and very convenient to have this structure in place.
So now I'll go into the non-recourse loans. So you can obtain financing for an IRA investment, a little bit different of a structure than a standard mortgage. It's known as a non-recourse loan. So that basically means that the loan is backed exclusively by the property, not by personal guarantee as the IRA holder. So basically the only recourse if the loan defaults or is not paid back pretty much is the property.
Exactly.
So can't go after the IRA, can't go after you personally. So yeah, it's a little different in regard to the terms. Usually they require a little more down when you're going to a bank that does non-recourse loans, and higher interest rate, but still, possible nonetheless.
Yeah, exactly. I mean, at the end of the day, it's the IRA that's taking out the loan and not the client. Right. So that's why these rules are in place. Plus, it would be a prohibited transaction if the bank or lender considered your credit score or relied on a personal guarantee.
Exactly.
When it comes to qualification. So there are many reasons why this is a requirement, but again, financing is certainly possible, but there are some other considerations here because when you purchase a property with debt and there's financing involved, then any net profits attributable to the debt financing is going to be taxed. And the tax is called unrelated business income tax, which comes from unrelated debt financed income. So UBIT comes from UDFI.
Yep.
I suppose. So a lot of acronyms, and it's pretty wordy. But the UDFI is the net income attributable to the debt financing, and that amount would be subject to UBIT, unrelated business income tax. So basically, I mean, if you want to just break it down simply, the amount that's lent to the IRA is completely unrelated to the IRA. You know, those aren't contributions that were made to the IRA.
Right.
Those
Or even
aren't
like a
earnings.
401k that
Exactly.
you contributed 2 years ago.
That
So it doesn't really have any relation to your retirement accounts.
right.
Hence that rule.
Exactly. Yeah, and it's not earnings from contributions. So if again, any profits that are, or net profits to be specific, that come from or are derived from that debt financing, you're going to be taxed. That's what the IRS requires here. So keep that in mind. And my understanding is UBIT follows the estate and trust tax schedule, if you wanted to take a look at that. But yeah, I mean, again, it's net profit. So you can take advantage of some expenses and depreciation when calculating that total, and you would do that with a CPA. I just want to actually, this is a good time to mention that
Yeah.
we're a passive custodian. We're really only maintaining the IRA, providing support as needed, and taking care of IRS reporting. So we're not providing any advice, no tax advice, no financial advice. So you would work on determining if UBIT applies with your CPA or with a tax professional.
Yeah, for sure. And then we'll go into prohibited transactions and disqualified persons in this slide here. So on the left, you'll see the key of the people you can transact with and can't transact with. So basically, figure anyone lineal, ascendants and descendants are pretty much off limits. So including, like you see there, you, a spouse, son, daughter, daughter-in-law, son-in-law, grandchild, father, mother, grandfather, cannot transact with. Alternatively, you can, if you wanted to work with a brother or sister or a cousin, close friend, nephew, niece, uncle, aunt, that's totally fine. So just to note that there on the left. And then I guess a couple examples of prohibited transactions. The first one's per se prohibited transaction. So one example here, if an IRA owner purchased a property that they personally own, or a disqualified person to their IRA owns. So yeah, pretty self-explanatory there. Just can't do that. I guess self-dealing.
Yeah, per se in this context really just means a transaction with one of the disqualified individuals.
Right.
Yeah.
And then extension for credit, prohibited transaction. And then the example there is if the IRA owner obtains financing for their real estate investment and they personally guarantee the loan, which Will alluded to a couple of minutes ago. And then lastly, self-dealing prohibited transaction. If the IRA owner or a disqualified person benefits from the IRA-owned property in any way, stay at the property to vacation, play golf on the property, hunt on the property in some cases.
Yeah.
And if they rent it out and allow someone else that's disqualified in the key on the left to stay on that property free of charge, things of that nature, that's known as a self-dealing prohibited transaction.
Exactly. And even if a disqualified individual is paying, let's say, fair market rent to the IRA, I could see someone arguing, hey, well, why would that be prohibited? It's the same rate that anyone would pay. It's because that would be a per se prohibited transaction at that point, because that's just a blatant transaction with the disqualified individual. In case anyone was thinking that, so just wanted to make sure that's clear. Yeah, exactly. So really, just making sure that you're not transacting with these individuals is very important when it comes to real estate. It applies to other asset types, but for real estate, this is so important to make sure you're not jeopardizing the IRA, because if a prohibited transaction does take place, the IRA is effectively distributed as of December 31st, or I believe it's the beginning of the year of the year in which the transaction took place.
Yeah.
So that could be a very large tax bill plus penalties if you're under 59 and a half at that point. So really, at the end of the day, arm's length transactions with unrelated third parties is the way to go. Obviously, you can still transact with certain family members, but you wouldn't want to give them, let's say, a sweetheart deal,
Right.
quote unquote, where now the IRA is suffering in order to benefit someone that's close to you, which could also be considered prohibited. So a lot of ways to look at this. So generally speaking, just make sure you're not dealing with anyone that's too close.
So we went into this a little bit in the last couple slides, but can an IRA owner or any disqualified individual live in, rent, or personally manage the IRA owned property? So an IRA owner or disqualified person cannot live in or rent out the IRA owned property in any circumstance, pretty much. But it can act as the property manager of the IRA owned property. So they can, hire contractors, vet tenants, all of that administrative work's totally fine. But they cannot personally benefit by giving themselves a salary or putting in any sweat equity
Right.
on the property. So you can basically, tell you want to do work on the property, but you can't pick up the hammer, pretty much.
Exactly. That's a weird one, but definitely keep that in mind. No physical labor from you or any other disqualified individuals. Yeah, so here is the process for investing in real estate without the checkbook control LLC in place. So setting up the account online is very simple. It takes, I'd say, 10 minutes usually. And from there, funding. Most clients are transferring from existing IRAs, but maybe you have a 401k from a previous employer, or maybe you've reached the age where you're able to move funds over from a 401k freely. That's really what we mean there. So for a transfer from an IRA, fill out our transfer authorization form. For a 401k rollover or similar type of qualified retirement plan, just contact the plan admin. All they need are Madison's delivery instructions, and they can cut a check or send a wire to your IRA, no problem. And whichever way you go, 401k rollover or IRA transfer, no tax implications and no penalties as long as it's done per the directions we provide. And that brings us to the investment. So you're going to direct Madison as to where the funds are going on our investment authorization form, but it's not that simple because, as I mentioned earlier, you do need to send us the documentation for the investment. So the purchase contract, a draft of the deed, a draft, because we know we're just in the beginning phases here, settlement statement or closing statement, and title policy, if applicable. I think we go a little bit more into it on this slide. Yeah.
So just like you said, purchase contract, closing statement, draft of the deed, title policy, and then all funds must come from the self-directed IRA for pretty much anything related to the property, just in general. But yeah, and again, to bounce off the conversation before about the checkbook IRA, these aren't required to give to us
Exactly.
in the LLC's case.
Exactly.
So just keep that in mind.
We're just funding the LLC, and you'll take care of the purchase from there and make sure you're transacting within the rules. And again, I mentioned this earlier. Definitely make sure the account is opened and funded so that the purchase contract can be in the name of the IRA from the beginning and earnest money can be paid from the IRA. I've worked with a number of clients who, some have been successful, some haven't, with reversing a transaction that they started. So just keep that in mind. You're going to make your life so much easier by just coming to us before you start making offers. We'll still do our best to help you, but we can't make any promises.
That's why I usually ask you to talk to a CPA or a tax attorney to kind of reverse that, because again, we can't give advice.
Exactly. Yeah. I mean, exactly. We try our best not to go too far into that lane of providing advice.
So we got transferring property into the self-directed IRA. Sorry, it took a second to come up there. But basically, Madison Trust requires a recorded deed, which transfers the ownership from the client's existing IRA to their Madison Trust IRA. And this deed would basically be signed and notarized by their previous custodian. And then the client will need to get the deed recorded with the county. Good to note there. And then once Madison Trust has a scanned version of the recorded deed, we can acquire the asset in their new self-directed IRA. I'll say my Madison Trust clients have the option basically to hold onto the recorded deed and send it to us for safekeeping. Then lastly, an appraisal is not needed for the transfer of the property. The only time Madison Trust requires an appraisal is if the client is trying to complete an in-kind distribution of the property, which we'll go into on the next slide.
Yeah, or in-kind Roth conversion.
Right,
too.
exactly.
Yeah. Yeah. So when it comes to distributing a property, first of all, it's possible, which some of you may not have known before this. But let's say you purchase a property in the IRA with the intent of maybe living in it at some point. Obviously, as we mentioned, you can't do that while it's under the IRA. So you can take it out of the IRA as an in-kind distribution. And it doesn't need to be done in one fell swoop, because that can be a large tax bill if this is a traditional IRA we're talking about. It can be done partially. So some of the equity is transferred to you for the distribution. And this could be a way to satisfy RMDs as well. But when it comes to the actual process, you will fill out a distribution form online. We'll definitely need an appraisal. For a taxable event like this, we need an accurate value. So that can be a certified asset valuation from a CPA. My understanding is a certified appraisal from a licensed agent or similar would work as well. And definitely a draft of the deed indicating the assignment of ownership from the Madison IRA to you personally. And we can even do this if a property is held under the LLC. You could do some of the equity of the LLC, have that transferred to you personally, or we can literally distribute some of the property or a property from the LLC to you personally. That we don't go too far into it on this slide or in this presentation, but our transfers team can assist if that's something that you wanted to do. And again, this is a taxable event that we're talking about. So it would be our responsibility to draft, or excuse me, to file the applicable IRS form, which would be Form 1099-R. And yeah, some of you might have RMDs that you're taking now, or it's something that you're anticipating. So provide us with those updated valuations each year. Maybe you have enough cash in the IRA to satisfy your RMD. That's fantastic. If not, this in-kind distribution method works perfectly. It is a bit more involved, don't get me wrong, but it's something we can certainly accommodate for you. Thank you everyone for joining.
Yeah.
It's always a good time to
100%.
hop on these webinars, especially with Ryan.
Yeah.
So, so yeah, thanks again, and hope to see you soon.